Okay, so here's where we left off with the last one. I actually lost my PowerPoint, but I think I've pretty much recreated it here. So here we did a statement of cash flows, and in this one they were really nice and they told us how much the dividend payment was or how much we got when we sold the land. But sometimes they don't tell you how much it is, and we can still get to it, what we need. So cash flows from investing, and what I'm really going to be talking about here is when I need to use the comparative balance sheet to figure out what happens when they don't tell you how much the transaction was for. Sometimes they don't even tell you if it was, but you can figure it out. So again, we're talking about property, plant, and equipment and long-term investments. So these are our long-term assets. If they don't tell you, so the general rule is always, you know, I'll put beginning balance in an account, which we'd get from one balance sheet, plus what went in minus what went out will equal our ending balance. And we can use that to figure out kind of a lot. For example, if we're looking at equipment, the beginning balance in the account plus any purchases I made minus any sale of equipment will equal my ending balance. So you'll always have the beginning and the ending balances on the comparative balance sheets. As long as they tell you one, there were no new purchases, then you can figure out what the sale was. Another one, sometimes you might have to figure out a gain or a loss if they don't give it to you on the income statement. So you could take the cost of the equipment, which you'll find on the balance sheet, right? That's what's sitting there for equipment, minus accumulated depreciation, which would also be on the balance sheet, plus the gain, or minus the loss, will equal the cash for that sale. So if they don't give you the cash, but you can find the gain or the loss on the income statement, and the other two on the balance sheet, you can figure out how much they sold it for. Or if they give you the cash, you could figure out if there was a gain or a loss. So those are some things you might see in the investing section. The financing section, we have the same type of thing. So we've got changes in long-term liability, and again, those comparative balance sheets. We're looking at what happened on those balance sheets. Remember that if debt is increasing, so is cash, because we're borrowing money. So for instance, let's say you wanted to figure out the payments they made on long-term notes payable. Long-term notes payable, again, the beginning balance, plus any new debt that I issued, that would add to that would be going into that account, minus any payments I made, would equal my ending balance. So as long as you always have the beginning and the ending, as long as they give you one or the other one, they took on no new debt, then you know that's a zero, and then you can solve for the payment. The other one you might run into is when you have to figure out the dividend payment. So to figure out what the dividend payment was, or even if they figured out dividend payments, you could do the beginning retained earning balance plus the net income minus any dividend payments will equal my ending retained earning balance. So again, balance sheet off of those two comparative, this would be coming from your income statement, and then you could figure out if they made a dividend payment just by solving for X there. So as long as you have at least three, you can figure out what happened in the fourth. So this next problem is an example of that. We're going to use this data for two problems here. The first one says, compute the acquisition of plant assets for this company. So we have comparative balance sheets. Here's 2015, so that's our beginning, and here's 2016, so that's our ending. So this is our old one, this is our new one, and then we have some stuff from the income statement here as well. So the first they want us to figure out what's happening in plant assets, which is right here. And assume no plant assets, they sold no plant assets during the year. So if we take the beginning balance plus any purchases that we made minus any sales, so what we started with plus what we put in minus what we took out, will equal our ending balance. So the beginning balance is $80,350. We're trying to figure out what the purchases were. We know there's no sales here, right? Because they told us that. And the ending balance is $108,250. So if we just kind of solve for x there, we get 108,250 minus 8,350, and we've got 27,900 must equal my new purchases for equipment or for plant assets. The second one wants us to calculate the payment of the notes payable during the year. And so we go down here to notes payable. They tell us that they issued another 4,600 in notes. So again, we'll go with the beginning plus the new notes issued minus payments, what we're trying to figure out, will equal the ending. So the beginning balance was 11,000. We issued 4,600 in new. We're trying to figure out the payment, and the ending was 10,000. So I will add x to both sides, so my x becomes positive, and swing that 10,000 over there. So I'll have 11,000 plus 46 minus the 10 will give me 5,600. Must be my payment on the notes payable. So that's just a couple of them. The next problem has us do this entire thing. So we've already figured out some of these, right? We've got our 5,600 here and our 27,900. So we'll be able to use some of these. But I think the easiest way to work it here is to use this page to do our math here, and then put them all together. So for operating, we'll start with our net income, right? That'll go under operating. We'll have our depreciation expense here. We'll have to go under operating. And let's see, this will be my beginning and ending cash balance. So I'm going to try to get from this 1,600 net income to this ending balance of 4,900. So accounts receivable will go under operating, right? This went up, so this increased by 1,000. And remember that in current assets, they work the opposite, so that will be a subtraction. Plant assets we just figured out, right? So that will go under investing, and that'll be a plus, and we purchased 27,900. That's what we just figured out here on the last problem, 27,900 purchases. Accumulated depreciation, we could use this to figure out what the depreciation expense was, but they give us depreciation expense over here, so we don't really have to do that one. But that will be an addition. Accounts payable, that's a current liability, so that goes under operating. That increased by 2,500, and liabilities work in the same direction, so we'll add that in. Notes payable, we already figured out, right? So notes payable go into the financing section, and we had a payment of 5,600, so that'll be a minus. And then we'll have a plus of, what do we say? 4,600 was the new one we issued, right? So that'll add to cash because I borrowed money and then I paid cash of 56. That'll bring that down. Common stock increased by 5,000. So that must mean I issued new stock. So that'll be financing. And if I issued stock, I got money. So that'll be a plus. And then retained earnings. So let's look at retained earnings to see if we made any dividend payments. So the beginning retained earnings is 52.2 plus the net income, which is right here, 1,600, minus dividend payments would equal my ending retained earnings. 48.5, and I'm going to solve for x. So x will end up being the 52 minus the 16 minus the 48. So that must mean I paid 5,300 in dividends. dividends paid. So that'll be an addition to financing. So now I've pretty much got everything I need to do the entire statement of cash flows. So I've got my beginning balance, I've got 1, 2, 3 things in operating, 1 in investing, and then 4 different things in financing. So then we can go ahead and write that. It'll actually look like this. So here's my net income that I started with, and then depreciation expense came off of my income statement. And this is my increase in accounts receivable, my decrease in accounts payable. So I get a total here of a positive cash flow of $28,400. I add that to my net income, and so here's my net cash flows from operating, $3,000 or $30,000. I just had that one investing where I purchased the plant assets, so that's a negative over here of $27,900. And then here were my 4 things from financing. I issued stock, I issued a notes payable, I paid dividends, I made a payment on notes payable. So that's a total of negative $13,000. So I do the $30,000 minus the $27,900 minus the $13,000, and I get a net increase in cash of $800. I started with $4,100. I added 8, and I end up with $49,000. So that's my ending balance. And if I go back here, that's my $49,000. So that's how I get from the net income of $1,600 to the ending cash balance of $4,900. Now I did want to just for a second kind of look at what these things mean. So you might first say, well, $800 increase in cash flow, that's not really that good. But it's kind of important to look at what it's coming from. They've got a positive cash flow from operations, and that's good. That's where you want your money coming from. We've got a negative cash flow here from investing, but that's because they're purchasing plant assets. So that's probably good. That's probably investing in future productivity. And here they're not taking on, it's a negative cash flow, but that's because they're paying their stockholders and they're paying off their debt. So again, that's not necessarily bad either. If they have a big positive cash flow, but they've got a negative cash flow from operations, there's probably a problem. That means the only reason they have a positive cash flow is because they're selling off assets or selling off investments or taking on a lot of debt or taking on a lot of having to issue a lot of equity. So that's not necessarily healthy. Sometimes even when somebody has a negative cash flow, that can not necessarily be a bad thing because they might be have a lot of cash from operations that they're ended up paying off debt and paying dividends to their stockholders. So a positive cash flow isn't always good. A negative cash flow isn't always bad. You really have to kind of look and see where that money's coming from, where that's going. And that's why the statement of cash flows can really tell us a lot about what's going on with that business. If we look back at some of these other ones, where's another guy here? This guy, he's got positive cash flows here from operations, so that's good. Here he's got money coming in, but that's because he issued a lot of stock, which may or may not be good. And on this one, he sold some land and he purchased some new equipment. So this stock might actually be financing this purchase of equipment, and that's not bad. But that's why potential investors or potential stockholders really want to look at this statement and see what's going on. And there's one other thing that the potential investors and potential stockholders will look at, and that's free flow cash. And that's really how much cash a company can free up or make available to take advantage to take advantage of opportunities that come along, for new opportunities, let's say that. So maybe a great investment comes around or a new company that they could buy or something like that. So that's just, you take the net cash from operating minus, so the net cash from operating minus any payments for long-term assets that they've already set aside, minus any cash dividends, and that equals your free flow cash. So it's a pretty straightforward little, there's a problem in the demo problems if you want to do it, long-term assets. So they've got, $100,000 free flow cash, but they've already they've purchased the new equipment and they've agreed to $20,000 in dividends. So you subtract that off, and that's how much free flow cash they have available so that they can free up if some kind of new opportunity comes along. So there you go. That's chapter 16 for you. Let me know if you have any questions.